Let's get right into it. There's this weirdly predictable pattern in the US stock market. It happens in the second year of a presidential term, and frankly, it's a time that usually makes investors super uncomfortable. You see more volatility, a lot of negative headlines, and some pretty big market dips. But what if all that anxiety is actually hiding a major historical opportunity? So, that's the big question we're tackling in this explainer. Why does this happen? Why is this one specific year, year two, so consistently choppy for investors? We're going to dig into decades of market data to really unravel this thing, and I think you'll find the answer is pretty surprising.
So let's start with the basics. We're talking about the midterm year. And just like the name says, it's the year of the midterm elections. It has this reputation for being a really rough ride for the market. But understanding why it has that reputation, well, that's the key to seeing the whole picture.
Okay, so here's the crucial idea to hang on to. The midterm year isn't just a random slump. Historically, it acts as a reset phase. Think of it as the time when the market finally digests all the new political stuff, adjusts its expectations, and basically clears the deck for whatever's coming next. And that leads us to the main point. If you only remember one thing from all this, make it this. The midterm year, historically, isn't about hitting home runs. It's about laying the foundation for much better performance later in the cycle. It's the setup.
All right, so that's the theory. But let's look at the hard numbers. We're going to dive into what decades of S&P 500 data, going all the way back to 1950, actually tell us about this pattern. And believe me, the numbers tell a really consistent and pretty fascinating story.
First up, the part that confirms all the anxiety. Average returns during midterm years are, well, a lot weaker. As you can see here, we're talking about maybe 4 to 6% on average. Compare that to the usual 9 to 10% in other years, yeah, it's a big drop. On the surface, it's not very exciting.
And it isn't just about lower returns. This is what really quantifies that feeling of discomfort. Volatility is way higher, jumping up to 15 to 17%. And check out the drawdowns. That's the drop from the peak within the year. It averages a really painful 18 to 20%. So yeah, it feels worse because it is worse. But this is exactly where the story takes a turn. And boom, here's the twist. This is what happens, on average, in the 12 months after the midterm elections. We're talking about returns of around 15%. It's such a huge contrast, and it really suggests that all the pain of the midterm year is exactly what sets the stage for the gains that follow. So you see, it's not just what happens, it's when it happens. The timing within the year is everything. There's this really recognizable journey that markets have taken time and time again during these midterm years, moving from struggle to finally resolution. Let's walk through that path. This timeline really lays it out. The year usually starts weak. The market struggles, earnings forecasts get cut. Then, by late summer, volatility often hits its peak. That's maximum fear. But then, something shifts as we get into the fall. The elections happen, which brings policy clarity, uncertainty starts to fade, and the market begins to look forward to stronger returns. And this quote just captures that turning point perfectly. The recovery doesn't start because the economy is suddenly booming or the data is perfect. Nope, it's triggered by getting rid of uncertainty. As soon as investors get a clearer picture of what the political and policy world will look like, even if it's not a perfect picture, they can start moving forward again.
Okay, so we've covered the what and the when, but the big question is why? Why does this pattern repeat itself so consistently? Well, it turns out there are 4 main drivers that show up again and again, creating this predictable, even if it's uncomfortable, cycle.
Think of these as the 4 horsemen of the midterm market. First, policy uncertainty is just at its absolute max. Second, presidential approval ratings tend to be at a low point, which just adds to the noise. Third, this year often lines up with the Fed tightening monetary policy or government stimulus fading away. And fourth, all that bad news just washes out the optimism, resetting everyone's positioning for the next route. Now, let's add one more layer to this: commodities. Stuff like oil and metals. Their behavior is a huge piece of this puzzle. Early in the year, when commodity prices are all over the place, it fuels inflation fears. But here's the thing. Historically, those inflation pressures often peak around mid-year. When those prices finally start to calm down, it sends a signal to the market that, hey, maybe the Fed won't have to be so aggressive after all. And that sigh of relief is often the green light stocks we're waiting for. So what does this all mean for you, the investor? How do you take all this historical context and turn it into a smart perspective? It's really not about predicting the future. It's about understanding the environment you're actually in. So the optimistic case, the bull case, isn't that the midterm year is going to be easy. Far from it. The bull case is that the midterm year is when all the necessary things happen to set up the next big advance. Fear is at its highest, expectations are at their lowest, and that wild volatility actually becomes the opportunity to get positioned for what has historically come next.
But of course, we've got to be real about the risks. This pattern is a strong tendency, not an ironclad guarantee. A really deep recession, not just a slowdown, could break the pattern. Same with inflation that just won't go away, or a major geopolitical shock. You've heard it before, but it's true. History rhymes, but it doesn't repeat word for word.
And that brings me to a really important point. Everything we've talked about here is historical context. It is absolutely not financial advice. Every investment involves risk, and this is all about understanding historical patterns, not trying to make a prediction.
And that really brings us to the final and I think most important thought. Understanding this cycle isn't about trying to time the market perfectly. Good luck with that. It's about being prepared, so you can respond with discipline instead of emotion. It's about reframing volatility not just as a risk, but as the potential opportunity it has so often turned out to be. So the real question isn't what the market will do next, it's how will you be prepared for it.